3. Whole life and term 100 insurance. This chapter introduces the concept of permanent life insurance and explores two types of permanent life insurance, whole life and term 100, T100. 3.1 Concept of permanent insurance. Permanent life insurance provides coverage over the entire lifetime of the life insured. It does not expire, as long as the required premiums are paid, and it does not need to be renewed. 3.1.1 How permanent insurance differs from term insurance. One of the drawbacks of term insurance is that coverage ends at the end of the term, unless the policy can be renewed. Most insurance companies will not provide term insurance coverage past a specific age, often around age 75 or 80. This means that they will stop issuing new policies at about age 65 or age 70, depending on the policy's term. So, term insurance cannot provide adequate protection against the risk of death for people who might live beyond this age. Permanent life insurance can provide the extended protection needed for risks that do not have an expiry date. The premiums for term insurance coverage typically increase with the age of the life insured, as shown in diagram 3.1 below. Life Insurance Chapter 3, Whole Life and Term 100 Insurance 28. Diagram 3.1, comparing 10-year renewable term and whole life premiums for coverage of $250,007. At advanced ages, term insurance can become prohibitively expensive. Premiums for permanent insurance typically remain level over the lifetime of the life insured. Premiums in the early years of a permanent insurance policy tend to be higher than premiums for a comparable amount of term life insurance. The excess amount paid for a permanent policy is used to build up a reserve that helps fund the higher cost of insurance later in life. 3.1.2 Types of permanent insurance. There are three main types or categories of permanent life insurance. They are black small square whole life, black small square term 100, T100, black small square universal life, UL. They are introduced briefly below. Whole life and term 100, T100, are discussed in detail in this chapter, while universal life is covered in the following chapter. 3.1.2.1 Whole life. Whole life insurance provides coverage for the entire lifetime of the life insured, with a premium that typically remains level over the duration of the contract. A whole life policy builds up a cash surrender value, CSV, over time, and if the policyholder surrenders the policy prior to the death of the life insured, he may be entitled to receive payment of that CSV, less any surrender charges, if applicable. 3.1.2.2 Term 100, T100. Term 100, T100, life insurance also provides coverage for the entire lifetime of the life insured, but the policy matures at age 100, such that premiums are no longer payable. T100 policies typically do not have a CSV. Term 100 is also a name widely used in the industry for this product. 3.1.2.3 Universal Life, UL. Universal Life, UL, insurance provides coverage for the entire lifetime of the life insured, but it also includes a savings component that is created through the deposit of excess premiums. Within certain limits, the policyholder can use a UL policy to accumulate savings that are completely sheltered from tax if they form part of the death benefit, or tax-deferred if they are withdrawn prior to death. UL insurance policies are noted for the flexibility they provide the policyholder. 3.2 Overview of Whole Life Insurance. Whole life insurance is a form of permanent life insurance that typically guarantees the premiums, the death benefit, and minimum cash surrender values, CSV, for the policy. It is sometimes referred to as straight life or ordinary life insurance. 3.2.1 Coverage Term. Whole life insurance provides coverage over the entire or whole life of the life insured. Unlike term life insurance, a whole life policy does not expire, does not require renewal, and cannot be cancelled by the life insurance company, other than for non-payment of premiums. 3.2.2 Policy Reserve. Premiums for a whole life policy typically remain level over time. In the early years, these premiums exceed the amount needed to cover the actual risk of death. This overpayment creates a policy reserve, which the insurance company invests to achieve even more growth. In the later years of the policy, the premiums paid fall short of the amount needed to cover the mortality costs and expenses of the policy. The policy reserve is used to offset or subsidize this deficit. 3.2.3 How premiums are set. Premiums for whole life insurance policies are based on long-term assumptions about mortality costs, expenses, and investment returns. The insurance company must project these factors over the duration of the contract, which could mean 50 or 60 years, or even more into the future. Because of this long time horizon, the insurance company uses very conservative assumptions. 3.2.3.1 Mortality costs. Mortality costs approximate the insurance company's cost of paying out policy death benefits. In the case of a term life insurance policy, the annual mortality cost of the policy is estimated by multiplying the policy's face amount by the life insured's probability of death during that year. With term insurance, there is a chance that the insurance company will not have to pay out the death benefit, because the policy term could expire before the life insured dies. In the case of a whole life insurance policy, the annual mortality cost is still estimated by multiplying the policy's face amount by the life insured's probability of death during the year. However, with a whole life policy, the insurance company knows that it will eventually have to pay out the death benefit, unless the policyholder decides to surrender the policy prior to death. When calculating the premiums for a whole life policy, the insurance company spreads the cumulative annual mortality costs over the anticipated duration of the life insurance contract. 3.2.3.2 Expenses. As with a term insurance policy, the premiums for a whole life policy have to cover the insurance company's expenses, including black small square cost of selling the policy, example, marketing, salaries, or commissions to agents. Black small square underwriting the policy, example, processing applications, paying for medical exams. Black small square issuing and administering the policy. Black small square paying income taxes. Black small square investigating claims. Black small square paying death benefits and the profits sought by shareholders. With a whole life policy, the insurance company must make assumptions about these expenses well into the 3.2.3.3 Investment returns. The insurance company invests the policy reserve to achieve additional growth. When determining the appropriate premiums for a whole life insurance contract, the life insurance company must make assumptions about the returns it will make on those investments over the duration of the life insurance contract. Stock market history has repeatedly demonstrated that actual investment returns can vary greatly from projections. 3.2.3.4 Impact of modal factor. Life insurance premiums are normally quoted on an annual basis, and premiums are payable in advance. For example, if a new policy is issued on March 1st, the annual premium paid on March 1st would provide coverage over the following 12 months. Remember that one of the pricing factors that affect insurance premiums is the rate of return the insurance company expects to get on invested premiums. When premiums are paid annually in advance, the insurance company gets the benefit of investing those funds for up to a year. However, the policyholder can usually choose to pay those premiums semi-annually, quarterly, or monthly. The insurance company calculates the periodic premium payment by applying a modal factor that reflects the insurance company's loss of investment income, compared to the income it could have earned on an annual premium. Sample modal factors for terms and whole life policies are shown in Table 3.1. Table 3.1. Sample modal factors. Payment frequency modal factor 8. Semi-annually 0.51 to 0.53. Quarterly 0.26 to 0.30. Monthly 0.087 to 0.09. When the policyholder opts for monthly, quarterly, or semi-annual payments on a term or whole life policy, the total amount paid over the year, called the annualized premium, will always be higher than the quoted annual premium. 3.2.4 3.2.4 Premium options. Depending on the whole life insurance contract, the policyholder may have several options for paying the premiums, such as black small square ongoing premiums, black small square single premium, black small square limited payment. 3.2.4.1 Ongoing premiums. The traditional option involves paying a fixed premium for the duration of the contract, i.e., until the life insured dies or the policyholder surrenders the policy. This is sometimes referred to as a lifetime pay policy. Example: Helena is 40 years old, a non-smoker and in excellent health. She just obtained a $500,000 whole life policy on her own life. Her premiums will be $11,065 annually and they are guaranteed to never increase. 3.2.4.2 Single premium. At the other extreme, it may be possible for the policyholder to pay a single lump sum premium for life insurance coverage that will last for the entire lifetime of the life insured. An insurance policy is said to be paid up if no more premiums are needed to keep the policy in force for the life of the life insured, so by definition a single premium policy is also a paid up policy. 3.2.4.3 Limited payment. Limited payment whole life insurance is somewhere between these two extremes, with premiums payable for a specific period of time, example, for 10 or 20 years, or to a specific age, example, to age 65 or age 100, after which the policy is deemed to be a paid-up policy. Limited payment policies are discussed in more detail later in this chapter. 3.2.5 Death benefit options. Depending on the insurance company, the policyholder may also have some choice as to how the death benefit is determined. The policyholder has a choice between guaranteed whole life and adjustable whole life. 3.2.5.1 Guaranteed whole life. A guaranteed whole life insurance policy offers a death benefit and premiums that are guaranteed not to change over time, regardless of the insurance company's experience with mortality costs, expenses, and investment returns. By offering these guarantees, the insurance company is taking on all of the risk stemming from its assumptions about these pricing factors. This risk can be significant over the long time horizon of a permanent insurance policy. 3.2.5.2 Adjustable whole life. In contrast, an adjustable whole life insurance policy offers a death benefit and premiums that the insurance company may adjust periodically to reflect its actual experience. Usually the insurance company will guarantee the death benefit and premiums for a certain period of time initially, such as 5 years. At the end of that period, the insurance company will compare its actual experience to its projections, and also update its assumptions about mortality rates, investment returns, and expenses. As a result of this review, it may increase, decrease, or maintain the premiums and the death benefit. This exposes the policyholder to more risk than a guaranteed whole life policy. As a result, the premiums on an adjustable whole life policy will be lower than the premiums on a comparable guaranteed whole life policy. Policy. Example 1. Ranjit purchased an adjustable whole life policy 10 years ago, with an annual premium of $6,500 guaranteed for 10 years. As a result of its 10-year review, the insurance company determined that men who had purchased the same policy as Ranjit are actually living longer than expected, so the company has had to pay out fewer death benefits than expected. The insurance company reduced Ranjit's premiums to $6,415 annually, guaranteed for the next 10 years. Life Insurance Chapter 3, Whole Life and Term 100 Insurance 34. Example 2. Helmuth purchased an adjustable whole life policy 5 years ago, with an annual premium of $11,600 guaranteed for 5 years. As a result of its 5-year review, his insurance company noted that market interest rates had dropped, and that as a result they have earned less income on their policy reserves than expected. The insurance company increased Helmuth's premiums to $12,100, guaranteed for the next 5 years. While adjustable whole life policies are no longer common in Canada, they were along the evolutionary path that ultimately led to the development of universal life (UL) insurance. 3.3 Non-participating versus participating whole life policies. Whole life insurance policies are classified as either non-participating or participating, depending on how the insurance company handles any surpluses that result from the policies in that category. 3.3.1 How shortfalls or surpluses occur. Insurance companies base whole life insurance premiums on assumptions for mortality costs, expenses, and investment returns. They typically are very conservative in their assumptions to reduce their risk exposure, and this can result in surplus revenues. For example, surpluses would occur if black small square fewer people died than expected, i.e., actual mortality rates were lower than projected. Black small square investment returns were higher than expected. Black small square administrative expenses were lower than expected. The insurance company retains some of this surplus to boost policy reserves in case they experience a shortfall in revenue in the future. In fact, Regulators specify the level of policy reserves that an insurance company must maintain to fund future liabilities. 3.3.2 Non-participating policies. When non-participating, non-par, whole life insurance policies generate excess revenues, the insurance company will use some of this excess to keep their policy reserves at the levels required by the provincial insurance regulators. To the extent that the excess revenues are not needed for policy reserves, the insurance company keeps the surplus as profit. This profit will be added to the insurance company's retained earnings, thereby increasing the company's shareholders' equity, and or paid as a taxable corporate dividend to the shareholders of the insurance company. If the insurance company is not conservative enough in its assumptions for its non-participating policies and it realizes a revenue shortfall, the company alone bears the burden of that shortfall. The policy and the policyholder are not affected. 3.3.3 Participating policies. When participating, par, whole life insurance policies generate excess revenues, the insurance company will still use some of this excess to keep their policy reserves at the levels required by the provincial insurance regulators. However, to the extent that the excess revenues are not needed for policy reserves, the insurance company may distribute some or the entire surplus as policy dividends to the participating policyholders. While they are called dividends, policy dividends should not be confused with the regular dividends that a corporation might pay to its shareholders because they are taxed differently. If the insurance company is not conservative enough in its assumptions for its participating policies and it realizes a revenue shortfall, the company still bears the burden of that shortfall alone. Participating policyholders do not assume any risk for shortfalls, they will not be asked to pay additional premiums and their death benefits will not be reduced. In summary, participating policyholders have the potential to share in revenue surpluses while non-participating policyholders do not. For this reason, the premiums for participating policies are typically higher than the premiums for comparable non-participating policies. 3.3.3.1 Identifying the difference. Most participating whole life insurance products include the word participating in the product name. Also, participating policy contracts will clearly specify how and when policy dividends will be paid, and will include a caveat that policy dividends are not guaranteed and are only paid at the discretion of the insurance company's board of directors. 3.4 Dividend payment options for participating policies. Depending on the insurance company and the specific insurance product, the policyholder may have the choice of several dividend payment options. The policyholder usually makes this choice when he first purchases the insurance, but in most cases, he can switch to another option at a later date. The most common dividend options are listed and described below. Black small square cash. Black small square premium reduction. Black small square accumulation. Black small square paid up additions, PUA. Black small square term insurance. Black small square impact on death benefits and cash values. 3.4.1 Cash. Under the cash option, the insurance company will pay policy dividends to the policyholder in cash, by either check or direct deposit. Cash dividends are normally paid annually. The policyholder can then spend or invest this money in any manner he chooses. 3.4.2 Premium reduction. If the policyholder chooses the premium reduction option, the insurance company will apply the policy dividend to reduce the premiums payable for the coming year. The policyholder will receive a premium notice for the balance of the premiums due. In the early years of a policy, the policy dividend is usually less than the premium. However, if the policy has been in force for quite some time, the policy dividend may entirely offset the annual premium. If the policy dividend exceeds the premium, the excess can be paid out or allocated according to one of the other dividend options chosen by the policyholder. The premium reduction option is sometimes referred to as a premium offset option. Premium offset policies used to be a popular marketing concept, as discussed later in this chapter. 3.4.3 Accumulation. If the policyholder chooses the accumulation option, the insurance company will deposit the policy dividends into a separate accumulation account, also known as a side account, which is invested to provide additional growth. While the policy dividends may or may not be taxable, income earned as a result of the investment of these dividends will be taxable to the policyholder. The policyholder can withdraw the policy dividends and accumulated investment income at any time. 3.4.3.1 Investment options. Funds in the accumulation account normally earn interest income. Some insurance companies also provide the option of investing the policy dividends in their segregated funds. The number of segregated fund units that can be purchased will depend on the amount of the policy dividend and the fund's unit value at the time of purchase. 3.4.3.2 Upon death. While the policyholder can withdraw funds from the accumulation account at any time, he is not required to do so. Any funds left in the accumulation account on the death of the life insured are typically paid to the beneficiary of the policy. 3.4.4 Paid-up additions, PUA. Under the paid-up additions, PUA, option, the annual policy dividend is used as a single premium to buy additional whole life coverage that is paid up. This additional insurance takes the same form as the base policy, and will have its own death benefit and cash surrender value, CSV. The policyholder can usually surrender a PUA separately from the main policy, and receive its CSV without affecting the main policy. New medical evidence of insurability is not required to take advantage of the PUA option, because the insurance company takes the potential increase in coverage via PUAs into account when underwriting the base policy. PUAs provide a great way to increase the amount of coverage on the life insured, even if his health has deteriorated to the point where he would not normally qualify for new coverage. For this reason, PUAs are the most popular dividend payment option, with over 90% of whole life policies sold using the PUA option. The amount of the PUA depends on the size of the dividend. While the PUA does not require any evidence of insurability, the amount of coverage acquired will depend on the size of the dividend and the attained age of the life insured at the time of purchase. 3.4.5 Term insurance. Under the term insurance option, the annual policy dividend is used as a single premium to buy one-year term insurance. As with the PUA option, medical evidence of insurability is not required. The amount of term insurance acquired depends on the size of the dividend and the attained age of the life insured. 3.4.6 Impact on death benefits and cash values. Depending on which payment option the policyholder chooses, participating policy dividends may affect the death benefit and the CSV of the policy, including any additions. For example, Black small square the paid-up additions, PUA, option may increase both the CSV and the death benefit. Black small square the accumulation option may increase the death benefit, assuming the policyholder does not withdraw all of the funds in the accumulation account. Black small square the term insurance option may temporarily increase the death benefit, for the duration of the one-year term only. 3.4.6.1 Dividend Illustrations. To help policyholders understand how their participating policy works, agents often provide a dividend illustration, which is a graph or chart that shows what might happen to the policy's CSV and death benefit over time. When determining dividends, an insurance company will first group policies together based on certain factors, such as the type of policy and when it was issued. The insurance company will then determine a dividend scale for that block of policies, which specifies how the insurance company's surplus will be distributed. The dividend scale is based on a series of complex calculations that factor in the insurance company's experience with mortality, expenses, and investment returns for that particular block of policies. A dividend illustration assumes that the insurance company's dividend scale will remain the same for the duration of the contract. Because these factors cannot be guaranteed, the dividend scale can and often does change over time. In fact, many dividend illustrations now provide projections based on 2 or more dividend scale scenarios. Agents should ensure that policyholders understand that the results shown in the dividend illustration are not actual projections, and that they do not represent guaranteed results. 3.5 Non-Forfeiture Benefits. When a policyholder cancels a term life insurance policy or when the term expires, the policyholder is left with nothing of value. Whole life insurance policies typically offer non-forfeiture benefits, which are benefits that the policyholder does not forfeit, even if he stops paying the premiums. Non-forfeiture benefits are made possible because of the buildup of the CSV in the policy. As a result, the non-forfeiture benefits usually increase in value the longer the policy is in force. During the first few years of the policy, non-forfeiture benefits will be negligible because the policy has not yet had a chance to build up a CSV. As the CSV is depleted, example via withdrawals or automatic premium loans, APL, the non-forfeiture benefits will also be reduced. Depending on the insurance company in the contract, the policyholder may be able to take advantage of one or more of the non-forfeiture benefits described below. 3.5.1 Cash Surrender Value, CSV. If a policyholder cancels his life insurance coverage, he is said to have surrendered the policy. The cash surrender value, CSV, of a life insurance policy is the amount that the insurance company will pay to the policyholder if the policyholder surrenders the contract. A portion of the CSV will be taxable when received by the policyholder, as discussed in a later chapter. In the early years of a whole life insurance policy, the premiums exceed the insurance company's actual costs for the policy, and some or the entire surplus is used to help create a policy reserve. The CSV represents the fair or equitable portion of the policy reserve and any paid-up additions, PUA, that the insurance company will return to the policyholder if he surrenders the policy. A whole life insurance policy will typically specify what the guaranteed CSV will be at the end of each policy year. If it is a participating policy with a PUA option, the illustration may also show an additional non-guaranteed CSV amount that could potentially result from the policy's dividends. 3.5.1.1 Surrender Charges. It costs an insurance company a significant amount of money to issue an insurance policy, including underwriting and administrative costs and agent commissions. As a result, they usually levy surrender charges against a policy's cash value to discourage a policyholder from surrendering or cashing in his policy before they can recoup their expenses. The surrender charges usually decrease over time and are eventually eliminated entirely. For whole life insurance policies, the surrender charges are usually not specifically spelled out in the insurance contract. Instead, the illustration of the policy's guaranteed CSVs will show $0 for the first 3 to 10 years, depending on the policy, before beginning to increase gradually. 3.5.1.2 Policy Loans. When a policyholder owns a life insurance policy, he can usually obtain a policy loan from the insurance company of up to 90% of the policy's CSV. While policy loans do not have a specific payback schedule, the policyholder will be charged interest at current rates. If the policyholder surrenders the policy, the amount he would have otherwise received as the CSV will be reduced by the outstanding balance of the loan, plus accrued interest. Similarly, if the life insured dies while a policy loan is outstanding, the death benefit will be reduced by the loan balance plus interest. Example: Yolanda owned a $500,000 whole life policy on her own life with a CSV of $120,000. She took an $80,000 policy loan to use as the down payment for a cottage, and the loan's interest rate is 5%, compounded annually. 2 years later, she decided to surrender the policy. At that time, the CSV had increased to $136,000 and she still had not made any payments on the loan. Yolanda will receive $47,800 upon surrendering her policy, which is calculated as the CSV of $136,000 minus the $80,000 outstanding loan and minus accrued interest of $8,200. If she had died instead of surrendering the policy, her beneficiary would have received $411,800, which is calculated as the death benefit of $500,000 minus the $80,000 loan and the $8,200 in accrued interest. 3.5.2 Automatic Premium Loans, APL. Most whole life insurance policies offer an automatic premium loan, APL, option once the policy has developed enough of a cash surrender value, CSV. Under this option, if the policyholder fails to make a scheduled premium payment, the insurance company will automatically make a loan against the CSV for the amount of the missed premium. The APL option prevents the policy from lapsing if the policyholder forgets to make a premium payment, or if he needs to take a break from paying premiums for personal financial reasons. The APL provision can be used for more than one missed premium. In fact, if the policyholder misses multiple premium payments, the APL provision will be applied repeatedly, until the total of the policy loans plus interest equals the maximum set by the policy, usually between 90 and 100% of the CSV. Once this limit is reached and after a 30-day grace period, the policy will be terminated and the residual CSV, if any, will be paid to the policyholder. Example: Ella owns a $500,000 whole life insurance policy with a CSV of $226,000 and annual premiums of $11,500. She has been forced into early retirement, resulting in a substantial drop in income. She would like to keep the policy in force to meet her estate planning needs, but she cannot afford the premiums until her Canada Pension Plan, CPP, and Old Age Security (OAS) benefits commence in about 5 years. Ella can skip premiums for the next 5 years by using the APL provision because she has enough CSV to support this option. While this will reduce the death benefit by the amount of the unpaid premiums plus interest, it will allow her to keep the policy. She will also always have the option of repaying the loan and interest if, when she can afford to, which would restore the death benefit. 3.5.3 Reduced Paid-Up Insurance. The reduced paid-up insurance option allows the policyholder to stop paying premiums entirely, while still keeping some life insurance coverage in place for life. Basically, the policyholder uses the CSV as a single premium to buy a reduced amount of paid-up life insurance coverage. The amount of paid-up coverage will depend on the size of the CSV and the attained age of the life insured. No medical evidence of insurability is required, because the amount of paid-up coverage will be less than the coverage provided by the original whole life policy. Example, Kant. If Ella feels that she will never again be able to afford the $11,500 in annual premiums on her $500,000 whole life policy, she may be able to use the CSV of $226,000, assuming she never exercised the APL option, as a single premium to purchase a paid-up permanent insurance policy. The exact amount of the death benefit will depend on her age, but it will be less than the $500,000 provided by her original policy. 3.5.4 Extended Term Insurance. The extended term insurance option allows the policyholder to stop paying premiums entirely, while keeping the same level of coverage in place in the form of a term insurance policy instead of a permanent policy. The duration of the term will depend on the CSV of the whole life policy and the attained age of the life insured. Example, Kant. If Ella feels that she will never again be able to afford the $11,500 in annual premiums on her $500,000 whole life policy but she wants to keep coverage for the full $500,000 in place as long as possible, she may be able to use the CSV of $226,000, assuming she never exercised the APL option, as a single premium to buy $500,000 of term insurance. The exact term of that policy will depend on her age. 3.6 Limited Payment Whole Life. Limited Payment Life is a whole life insurance policy that provides lifelong insurance coverage, while only requiring premiums for a specified guaranteed period of time. Example. Hamish bought a 25-pay life policy on his own life when he was 45 years old. He only has to pay premiums for 25 years, at which point he will be 70 years old. However, the coverage will continue past age 70, right up until his death. Some limited payment life policies specify an age, instead of the number of years. For example, a limited payment life policy might only require premiums until age 65, while providing lifelong coverage. Once premiums are no longer required, the policy is said to endow. The premiums for a limited payment life policy will be higher than for a whole life policy where premiums are payable for life. This makes up for the fact that the coverage continues after payments cease. The insurance company determines the limited payment premiums by first estimating the total premiums it would have collected if the policyholder paid premiums for his entire life, based on his assumed life expectancy. It then determines the premiums it would have to collect over the limited payment period to provide the insurance company with the same financial result. Although the premiums for a limited payment life policy are higher than premiums for a lifetime payment policy, there are several benefits for the policyholder. Black-E knows exactly when the premiums will end. Often the pay period is chosen to coincide with retirement, particularly if the policyholder expects to have a lower level of disposable income in retirement. Black-it eliminates his longevity risk, which is the risk of living longer than anticipated or longer than average. For a regular whole life policy, premiums are payable for life, even if that extends to age 100 or even longer. Black-, the insurance company applies the time value of money principle, which reduces the cost to the client over the long term because the insurer has the use of his money earlier than a normal lifetime payment policy. 3.7 Premium Offset Policies. Earlier in this chapter, it is stated that participating whole life policies typically offer several policy dividend payment options, and 2 of these have the potential to eventually cover premiums entirely. They are described below. Black under the premium reduction option, policy dividends are applied against the premium owing. After the policy has been in force for some time, this can significantly reduce or even completely cover the premiums required. Black small square under the paid-up additions, PUA, option. The annual policy dividend is used as a single premium to purchase an additional amount of paid-up insurance. These PUAs have their own cash surrender values, CSV, which increase over time. Once the policy has been in force for some time, the policyholder can use the CSVs of those PUAs, together with the annual policy dividends, to completely cover the premiums required. These two premium offset options are both valid and viable ways of reducing or eliminating premium payments. However, history has shown that agents need to exercise caution when marketing policies with these provisions to prospective clients because policy dividends are not guaranteed. 3.7.1 Illustrations and Disclosure. In the 1970s and early 1980s, insurance companies packaged and marketed participating whole life policies with aggressive policy dividend illustrations, promoting them as quick pay or vanishing premium policies. The illustrations were based on dividend scales that reflected the high interest rates that could be earned at the time. As a result, the illustrations often showed the premiums vanishing in as little as 10 years. However, interest rates began to drop in the late 1980s and into the 1990s, and insurance companies dropped their dividend scales in response. Even a drop in the dividend scale by 1% significantly reduces policy dividends, and the decreases during the late 1980s and 1990s were much more dramatic. Policyholders who had expected their premiums to vanish or be fully offset in 8 or 10 years found out they would have to pay premiums for 20 or even 30 years. The illustrations used to sell these policies were not meant to be guarantees of performance. However, the way these policies were marketed made many policyholders believe that the results were guaranteed. And even when policyholders agreed that the illustrations were not guarantees, they maintained that they were never warned about how dramatically even a small change in interest rates would affect the dividend scale and ultimately how long they would have to pay premiums. For this reason, agents must be very cautious when providing policy illustrations to their clients. Agents must clearly disclose that the illustrations are based on the current dividend scale, that the dividend scale could change and that as a result the projections are not guaranteed. Furthermore, agents should emphasize that even small changes in the dividend scale could result in markedly different results than those shown in the illustration. Some insurance companies go as far as providing multiple illustrations, a primary illustration that is based on the current dividend scale, and a second reduced illustration that is based on a slightly lower dividend scale. Life Insurance Chapter 3, Whole Life and Term, 100 Insurance 44. 3.8 Advantages and Disadvantages of Whole Life Insurance. The advantages and disadvantages of whole life insurance policies are summarized in Table 3.2. Table 3.2. Advantages and disadvantages of whole life insurance. Advantages, disadvantages. Black small square premiums are guaranteed for life. Life. Black small square coverage continues for life, regardless of the age or health of the life insured. Black small square participating whole life policies may result in policy dividends, which the policyholder can receive in cash, choose to accumulate in an investment account, i.e., side account, or use to buy paid-up additions, PUA, or one-year term insurance. Black small square a whole life policy builds up a cash surrender value, CSV, over time, which the policyholder may receive if he cancels or surrenders the policy. Black small square in the later years, whole life policy premiums will likely be less than the premiums for the same amount of term insurance on a person of the same age. Black small square a whole life policy may offer non-forfeiture benefits in addition to the CSV, including automatic premium loans, APL, reduced paid-up additions, and extended term insurance. Black small square policyholder may be able to obtain a policy loan against the CSV of the policy. Black small square compared to more traditional guaranteed investments, the dividend payment rate on participating policies has historically had a lower standard deviation, i.e., lower volatility in the returns. Black small square high initial cost. In the early years of the policy, the premiums for whole life insurance will be higher than those for the same amount of term insurance, which may make it cost prohibitive for people with limited cash flow. Black small square policyholder has little or no choice over how the policy reserve is invested. Black small square for participating whole life policies, policy dividends are not guaranteed. Even a small change in the dividend scale can significantly alter the long-term performance results. Black small square. There is a theory that suggests buying term insurance and investing the difference may result in a better financial outcome, provided the policyholder is disciplined to invest the difference. Black small square. The way the policy reserve is invested/managed is not entirely transparent to the public. 3.9 Comparing term and whole life insurance. Table 3.3 summarizes the differences between term insurance and whole life insurance. Table 3.3. Term life insurance versus whole life insurance. Term life insurance, whole life insurance. Coverage. Black small square provides insurance coverage for a specified period or term. Black small square coverage is usually not available past a certain age, example, 75 or 80. Black small square. The term can be selected to meet a need of specific duration. Black small square provides insurance coverage for life. Black small square coverage is available for life, regardless of age. Black small square term cannot be customized to a specific duration, but can be surrendered at any time. Premiums. Black small square premiums generally increase with the age of the life insured. Black small square. While the life insured is relatively young, the premiums are generally lower than premiums for the same amount of whole life coverage. Black small square. As the life insured ages, the premiums eventually become higher than premiums for the same amount of whole life coverage, and may eventually become cost prohibitive. Black small square premiums generally remain constant regardless of the age of the life insured. Black small square. While the life insured is relatively young, premiums are generally higher than premiums for the same amount of term life coverage. Black small square. As the life insured ages, the premiums remain level. Eventually they will be lower than premiums for the same amount of term coverage. Coverage. Renewability. Depending on the contract, the policy may be non-renewable, or the life insured may have to provide medical evidence of insurability for renewal. However, some term policies are convertible, which allows the policyholder to convert the policy to whole life insurance without providing new medical evidence of insurability. Policy never requires renewal and will remain in force even if the health of the life insured declines. Policy to whole life insurance without providing new medical evidence of insurability. Policy never requires renewal and will remain in force even if the health of the life insured declines. Cash surrender value, CSV. Policy does not build up a cash value, so policy has no value upon expiry or termination. Policy never expires, and it builds up a cash surrender value, CSV, over time. Policyholder can receive CSV if he terminates or surrenders the policy. Term life insurance, whole life insurance. Investment. Black small square policy will not provide dividends. Black small square policyholder cannot borrow from the policy. Black small square. A participating whole life policy may provide policy dividends, although they are not guaranteed. Black small square policyholder may be able to take out a policy loan against the CSV. Benefits. Black small square policy does not provide non-forfeiture benefits. Black small square death benefit cannot be increased without providing medical proof of insurability and without payment of additional premiums. Black small square policy may provide non-forfeiture benefits, which generally increase in value the longer the policy is in force. Black small square death benefit can be increased, without providing proof of insurability and without paying additional premiums, by using a paid-up additions (PUA) option or by leaving policy dividends in the accumulation account. 3.10 Using whole life insurance. As a general rule, whole life insurance is more suitable than term insurance for addressing risks of unknown or long duration. Some of the issues that need to be considered when determining if whole life insurance is appropriate include how long the coverage is needed, how much the policyholder can afford to pay in premiums, his income stability, his willingness to pay premiums for life, his need for increasing coverage, and his investment objectives. This section provides some examples of when whole life insurance might be appropriate. 3.10.1 Taxes upon death. Probably one of the strongest arguments for whole life insurance revolves around managing the income taxes that come due upon death. This is particularly true for people who own cottages, i.e., cabins, business shares, or other investment assets that they want to leave intact to their children, and that are expected to appreciate significantly prior to death. Example: Henry is 50 years old and he is in great health. He is widowed with one son, Jack, who is currently 14 years old. Henry and Jack enjoy the time they spend together at the cottage, and Henry would like Jack to receive title to the property when he dies. Based on his family history, Henry believes he will live until at least age 90. Henry expects the value of the cottage to triple by the time he dies, and he is worried that there will not be enough money in his estate to pay the income tax on the taxable capital gain that will result from the deemed disposition of the cottage when he dies. He estimates that this tax liability could be $200,000 or even higher, depending on the real estate market. Henry would like to use life insurance to make sure that this risk is covered. However, he will not be able to get term insurance coverage that lasts until age 90 or beyond. A whole life policy would give him the protection he is looking for. If he changes his mind about leaving the cottage to Jack and he instead decides to sell the cottage before he dies, he can always keep the policy for other estate needs or surrender the policy and use the cash surrender value, CSV, as he chooses. 3.10.2 Future insurability. One of the benefits of whole life insurance is that it can provide lifetime protection at a guaranteed fixed price. Furthermore, if the insurance is acquired when the life insured is relatively young and before any health problems occur, it can be quite affordable. Example: Eric is already 45, and he had not even considered life insurance until his recent marriage and the birth of his son, Oliver, last year. Eric's sedentary lifestyle has resulted in him being overweight, with high blood pressure and the onset of type 2 diabetes. He was dismayed to learn how much the life insurance would cost because of his health, and even more dismayed to learn how much cheaper it would have been had he bought it when he was young and healthy. This prompted him to purchase a whole life policy on Oliver's life, so he would always have insurance protection. When Oliver is an adult, Eric can transfer ownership of the policy to him, with the added benefit that Oliver will be able to take out a policy loan against the CSV if needed for his education or for the down payment on a home. 3.10.3 Increasing coverage. Participating whole life insurance can provide an easy way to increase insurance coverage without increasing premiums, even if the health of the life insured declines. Tony is 33 years old with a young family, and he would like to obtain life insurance coverage for 10 times his salary. His salary is currently $60,000, but he expects it to increase dramatically over the coming years. He would like his new insurance coverage to keep pace with the increases in his salary, preferably without increasing his premiums. While Tony is currently in good health and would have no trouble obtaining life insurance, he knows that his father and his uncle both started experiencing significant health issues at about age 40. Tony is worried that if his health follows family history, he might be unable to buy additional coverage at an affordable cost in the future. A $600,000 participating whole life policy with a paid-up additions (PUA) option would be a good choice for Tony. The PUAs will increase his coverage without increasing his premiums, and without requiring proof of insurability. If it turns out that the PUAs add more coverage than Tony needs, he can always use the additional coverage to address other estate needs or surrender part of the policy and use the resulting cash surrender value, CSV, for other purposes. 3.11 Term 100, T100, Life Insurance. Term 100, T100, life insurance, also called Term 200 in the industry, combines elements of term insurance and permanent insurance. 3.11.1 Duration of coverage. T100 provides coverage for life. Some T100 policies mature at age 100, meaning the death benefit is paid when the life insured reaches age 100 or dies, whichever comes first. Other T100 policies only pay the death benefit when the life insured dies, but premiums cease at age 100, so the policy essentially becomes a paid-up policy. 3.11.2 Premiums. Premiums for a T100 policy cease when the life insured reaches age 100, even if the death benefit has not yet been paid out. Because T100 policies generally do not accumulate a CSV and do not provide non-forfeiture benefits, the premiums are typically lower than those for the same amount of regular whole life insurance. However, because T100 provides protection for life, premiums are higher than those for the same amount of term insurance coverage that stops at age 75 or 80. Because T100 policies generally do not accumulate a CSV, the policyholder cannot rely on automatic premium loans, APL, to cover any missed premium payments. This means that if the policyholder accidentally misses a payment and does not rectify this within the allowable grace period of 30 days, the policy will lapse. Essentially, the policy will be worthless, even if the policyholder has been faithfully paying premiums for decades up until that point. Some T100 contracts allow policyholders to reactivate lapsed policies, provided they do so within a specified time frame, usually 2 years, and they also pay the missed premiums. 3.11.2.1 Level Cost of Insurance, LCOI. Most T100 policies guarantee that the premiums will remain level for the duration of the contract, i.e., until age 100, and they do not provide for the accumulation of any cash surrender value or other non-forfeiture benefits. The level premium schedule for this type of T100 policy is referred to as level cost of insurance, LCOI. Although T100 premiums remain constant for life once a policy is implemented, it is important to note that those premiums will depend on the attained age of the life insured at the time the policy is issued. The younger the life insured is at the time of issue, the lower the premiums for life. 3.11.2.2 Limited Payment T100. T100 policies can also be issued on a limited pay basis, meaning that coverage is provided for life, but premiums are only payable for a limited number of years, example, 10 or 20 years, or until a predetermined age, example, age 65. At the end of the payment period, the policy becomes a paid-up policy. Limited payment T100 policies are not widely available in Canada today, but they have been issued in the past and these policies do still exist. Limited payment T100 insurance commands a higher premium than the same amount of straight T100 coverage, because the premiums are being paid over a shorter period of time. These premiums are held in reserve to help offset the higher costs of insurance as the life insured ages. As with the whole life policies discussed earlier in this chapter, this policy reserve generally results in a cash surrender value, CSV, that the policyholder can access if he surrenders the policy after it has been in force for a certain amount of time. Limited payment T100 policies may also offer the option for automatic premium loans, APL, which could help prevent the policy from lapsing if the policyholder misses any premium payments. 3.11.3 Death Benefit. The death benefit of a T100 policy is fixed for the duration of the contract. 3.11.4 Upon age 100. What happens when the life insured reaches age 100 depends on the insurance company and the details of the contract. Some policies specify that the death benefit will be paid to the beneficiary when the life insured turns 100. Other policies specify that the payment of premium ceases at age 100, but coverage continues until death. 3.11.5 Availability from insurers. Basic T100 policies, those without a CSV and with premiums payable until age 100, are readily available from major insurance companies and other financial institutions. Limited payment T100 policies are no longer common in Canada, but they are available in the US market. 3.11.6 Using Term 100. Term 100 insurance may be appropriate when the following conditions apply. Black small square The policyholder requires a fixed amount of insurance to cover a need that is not expected to increase prior to death, regardless of when that death might occur. Black small square The policyholder is certain that he will never want to surrender the policy. Black small square The policyholder has no need of the investment opportunities provided by Universal Life, UL, insurance. Example. Trevor recently lost his wife after a long battle against cancer. He was overwhelmed by the support that the local hospice center provided to his wife, himself and their children during the last 2 months before she died. Trevor is absolutely determined to donate $500,000 to the hospice center upon his own death. Trevor decided to buy a $500,000 T100 policy now, while the premiums are still affordable, because this will ensure that he will be able to make that gift even if he lives to be 110 and depletes all of his own resources. He has no intention of ever canceling the policy, so he does not need a policy that builds up a cash surrender value, CSV. Chapter 4, Universal Life Insurance. Competency component black small square analyze the available products that meet the client's needs. Competency subcomponent black small square analyze the types of contracts that meet the client's needs. Life Insurance Chapter 4, Universal Life Insurance 52.